Welcome to the deep dive. This is where we take these really complex sources, think dense tax codes, legal statutes, academic papers, and we boil them down. We find those crucial, high-value takeaways you can actually use. Today, our sources lead us into, well, a surprisingly specific, potentially quite lucrative corner of the IRS tax code. We're exploring a rule about renting out your own home for a very short time. It's often called the Augusta Rule. And the hook is, it can allow you to earn income from your home that's completely tax-free. So this deep dive is really for anyone curious about maybe making some money from their home without, adding it to their tax return. And it's definitely for business owners looking for legitimate ways to, well, manage their tax situation.
It really is a fascinating piece of the tax puzzle. The official term is usually something like minimal rental use, and it provides this really significant benefit. But like you said, the key is strict adherence. The limits are incredibly precise. It's amazing how just one day can make all the difference.
Okay, let's get into that. The core of this, the magic number everyone needs to know. What is that absolute limit?
14 days, that's the number. A homeowner can rent out their personal residence, their main home, or even vacation home they use personally for no more than 14 days total in a calendar year. And if you stay under that wire 14 days or less...
Then the big payoff.
Exactly. The income you earn from that rental during those, say, 10 or 12 or 14 days, it doesn't even get reported to the IRS. It's just tax-free.
14 days. Sounds straightforward. But you mentioned a cliff edge. What happens on day 15 if someone rents it out for that extra weekend day? Do they just pay tax on that one day's income?
No, and that's the trap. It's not incremental. If you hit 15 days or more, obviously you lose that special minimal use status entirely. And the consequence is you then have to report all the rental income earned for the entire year, not just the income from day 15 onwards. Yeah. All of it.
Wow. Okay, so let's say you rented it out for 2 separate weeks during the year, maybe a week in spring, a week in fall. 14 days total. You thought, great, tax-free income, but then maybe a friend stays one extra night and pays you, day 15. Suddenly, the income from those first 14 days is taxable.
That's precisely it. It retroactively becomes reportable income, which really highlights why tracking those days meticulously is so important.
Absolutely. Now, there's another side to this, isn't there? Deductions. If you're getting this tax-free income, you can't also deduct expenses, right?
Correct. That's the trade-off.
Yeah.
You get the benefit of not reporting the income, but you forfeit the ability to deduct any expenses associated with that rental period.
Yeah.
So no writing off the special cleaning crew you hired or a portion of your insurance or, fixing the leaky faucet that week. Nothing.
Clean slate then. No income reported, no deductions claimed. Seems fair, I guess, especially if the rent you're charging for those, say, 10 days is pretty substantial.
It can be a very good trade-off, yeah.
Okay, so the 14-day limit is crystal clear. But just counting days isn't enough, is it? The IRS looks at other factors, too, like how much you charge and how much you use the place.
Exactly. They want to make sure this isn't just a business masquerading as minimal personal use. So, 2 big requirements pop up. First one, fair market value rent.
FMV. Okay, how does that work in practice? If I'm renting my home out during, say, a big local festival or tournament, can I charge a premium? Or do I just guess?
You absolutely need to charge a fair rent comparable to what similar properties would fetch in your area during that specific time. So yes, if it's a huge event weekend, FMV might be much higher than usual, but you can't just, pluck a number out of thin air, especially if you're renting to, say, your own business, which we'll get to.
So you need proof, like checking local listings?
Yes, you should keep records. Screenshots of comparable Airbnb listings, local hotel rates for similar quality, maybe even quotes from property managers. If you're ever questioned, you need to show your rate was reasonable for the market at that time. Charging way over the odds is a red flag.
Makes sense. Keep it realistic. Okay, what's the second big requirement? You mentioned something about personal use.
Right, the personal residence use test. This is basically to make sure it actually is your personal residence. The rule says you must personally use the property for a certain number of days. And that number has to be more than the greater of these 2 figures, either 14 days or 10% of the total days you actually rent it out at fair market value.
Whoa, okay, that sounds a bit circular. Let's break that down.
Right.
For someone using the Augusta Rule, they're only renting for 14 days max anyway, right?
Exactly. So that 10% part usually doesn't bite them. Let's say you rent it out for the full 14 days.
Right.
10% of 14 days is just 1.4 days.
Right.
The other threshold is 14 days. Since 14 is greater than 1.4, the rule says you must use it personally for more than 14 days.
Meaning 15 days or more.
Precisely. So the practical reality for most people using this rule Rent it out for 14 days or less, and make sure you personally use it for at least 15 days during the year.
Okay, that simplifies things nicely. 14 days max rental income, 15 days minimum personal use. Got it. But what counts as personal use? Is it just me sleeping there?
Now that is where the definition gets really broad and potentially tricky. The IRS casts a wide net here to prevent, well, gamesmanship. A day of personal use includes any day the unit is used by, well, you, obviously, or anyone else who has an ownership interest in it.
So if my partner and I own it jointly, any day either of us is there counts.
Yes, but it goes further. It also includes days used by a member of your family, or the family of anyone else who has an interest in it.
So if my brother stays for a weekend, even if I'm not there.
Generally, yes, that counts as your personal use days, unless there's a specific exception.
Okay, what's the exception?
If that family member uses the property as their main home, their principal residence, and they pay you a fair market rental price, then those days usually don't count as your personal use days.
Okay. So if my daughter lives in my condo year-round as her main place and pays full rent, that's different.
Correct. But the big catch-all is this. Any day the property is used by anyone for less than fair rental price, that counts as a personal use day for you, the owner.
Anyone. So friends too. If I let a friend crash for a weekend and they just buy dinner as thanks, the fair rent would have been, say, $300 a night.
Those days. Personal use days for you. Because they didn't pay FMV. It's designed to stop you from essentially gifting stays while trying to maintain a certain rental status.
Wow. Okay, so tracking who is in the house, when, and crucially, what they paid compared to FMV. That's vital for both sides of this rule. Making sure you don't exceed 14 rental days and making sure you meet the 15 personal use days without accidentally counting gifted stays.
You absolutely need good records. And there's one more way a day gets counted as personal use. Rental swaps.
Rental swaps.
Yeah, if you let someone use your place and in return, under some kind of agreement, you get to use their place. The days they use your property count as your personal use days.
Okay. It really sounds like any non-arm's length, non-FMV use of the property generally pushes it towards the personal use category.
That's a very good way to summarize it. They want this tax break reserved for truly minimal market rate rentals of what is genuinely your personal home.
All right. This brings us to what seems like the most sophisticated application of this rule, especially for our listeners who run their own businesses, renting your home to your own company.
Yes, this is where it shifts from just being a nice little income bump to a potentially powerful tax strategy.
Sure.
The setup is the business owner arranges for their company, say, their S Corp or C Corp, to rent their personal home.
For what purpose, though? It can't just be because the owner feels like working from home that day, can it?
Oh, definitely not. It has to be for a legitimate, documented business purpose that genuinely requires the space. Think holding a formal board meeting.
Okay.
Or hosting a mandatory company retreat for your team. Maybe conducting a crucial training session or meeting with key investors or clients where using the home provides a necessary or appropriate venue.
So real business events, not just routine work.
Exactly. And the business needs to formally rent the space from the owner, paying fair market value, just like we discussed. And importantly, staying under that 14-day total annual limit for the property.
Okay, so let's trace the money and the tax impact. The business holds its quarterly meeting at the owner's house for, say, 2 days. It pays the owner $1,500 per day, which is documented FMV. That's $3,000. What happens next?
Two things happen simultaneously, creating this neat loop. For the business, that $3,000 rent payment is a legitimate business expense. It's deductible.
So the business's taxable income is reduced by $3,000?
Correct. And then for the owner, personally, they receive that $3,000. And because they stayed within the 14-day overall limit for renting their home that year,
that $3,000 is tax-free income to them.
Precisely. You've effectively moved $3,000 from the business, where it would have been taxed, into the owner's pocket, where it isn't taxed, legally.
That is quite an elegant outcome, but I imagine the IRS looks closely at these kinds of related party transactions.
Oh, absolutely. Scrutiny is higher. This isn't something they do casually.
So what's the absolute key piece of evidence if you get audited on this specific strategy, renting your home to your own company?
Documentation, documentation, documentation. First, proof of fair market value is paramount. You need those comps we talked about, showing why $1,500 a day was reasonable. Second, proof the event actually happened and was a necessary business function. Meeting minutes, attendee lists, agendas, maybe even photos or receipts for catering if applicable. And third, clear financial records showing the company paid the owner. A check. a bank transfer, not just an accounting entry. It needs to be a real transaction.
Makes sense. You need to show it was a genuine arm's-length rental for a real business need, even though it's between related parties. Which business structures work best for this? You mentioned S Corp and C Corp.
Yes, those work best because they are distinct legal entities, separate from the owner. Partnerships can also work well. It gets much trickier for, say, sole proprietors or single-member LLCs taxed as disregarded entities. The line between the business and the owner is blurred. While the basic Augusta rule still applies if they rent to an unrelated third party, renting to themselves effectively, well, it usually doesn't provide the same deduction benefit because of how self-employment taxes and business structures work.
So for that specific business strategy, having that corporate separation is really helpful.
It clarifies the transaction significantly, yes.
Okay, wrapping this up, this Augusta rule is a perfect example, isn't it, of how knowing these very specific kind of narrow parts of the tax code can genuinely create a financial advantage.
It really is. But it also shows how that advantage is completely dependent on respecting the very sharp boundaries. The 14-day limit is absolute. The FMV requirement is critical. And meeting that personal use test, the 15-day minimum, watching out for those non-FMV uses, is non-negotiable.
So for you listening, the big takeaway is this is a legitimate tool for potentially significant short-term tax-free income from your home. Could be renting it out for a local event, could be strategically renting to your own company, but you have to be incredibly organized. You need to count those rental days like a hawk. You need to track your personal use days carefully. And you absolutely must document fair market value for every single rental transaction.
Precision really is the name of the game here. It's the price of admission for the tax-free benefit.
Right. Which leads to a final thought. We talk about how complex it is to define and track personal use, especially when, family or friends using the place below market rates counts against you. How many people realistically are keeping a detailed log for all 365 days of the year, showing who is in their property, when, and whether fair rent was paid, just to be absolutely certain they meet the personal use minimums and haven't accidentally blown their Augusta Rule eligibility? It really makes you think about the level of record keeping required to be completely bulletproof on this. Something to chew on as you consider if this strategy fits your situation.